Welcome to TalkTickers, your deep dive into the latest earnings calls. Today, we're unpacking the Q2 fiscal 25 results from Hexatronic Group, that's ticker HTRO. They're a global player in fiber optic connectivity, think telecom, data center networks. Our mission, as always, is to really distill the core insights for you from their latest management update. We want to help you quickly grasp the financials, the strategic shifts, and what it all might mean going forward. So let's start with the headline numbers. What picture did they paint this quarter?
Well, the headlines definitely painted a challenging picture for Hexatronic. Revenue came in at SEK 1.906 billion. That's Swedish kroner. And that was, about 4% below what analysts were expecting. The consensus was around SEK 1.987 billion.
Okay, so a miss on the top line.
Yeah, and it wasn't just revenue. The diluted earnings per share, the EPS, landed at SEK 0.38. That was quite a bit short of the SEK 1.5 the street was looking for. Significant miss there.
Oof, okay.
And on top of that, their EBITDA margin, that's earnings before interest, taxes, and amortization, it compressed, dropped by 210 basis points compared to last year.
2.1%. That's quite a squeeze.
It is. It brought the margin down to 8.9%.
Yeah.
So, yeah, tough headline figures overall.
Right. Those are some difficult numbers at first glance. But what's really interesting here, I think, is that the pain wasn't spread evenly across the whole business, was it?
No, absolutely not. That's the key takeaway here, really. The overall decline was overwhelmingly driven by one particular segment.
Which one was that?
Their fiber solutions segment. Sales there slumped by a pretty significant 16%.
16%. Okay, that's the drag. But you mentioned bright spots.
Exactly. In stark contrast, you had data center revenue jumping a very robust 38%.
38%. Wow.
Yeah, really strong. And then harsh environment revenue also grew, up 4%. That segment actually hit an all-time high sales figure with double-digit organic growth.
Okay, so a real divergence there. Fiber solutions down hard, data center and harsh environment looking pretty good.
Precisely. So while the overall picture looked a bit gloomy, you had these clear pockets of strong performance.
That's a crucial distinction. So how did the market react? Because often that initial share price move tells you something about expectations, right?
Yeah, it does. The market's response was, you could say, kind of guarded pessimism. The stock slid a bit in the session right after the call, but it wasn't, a dramatic collapse.
Modest slide. But there's context there, isn't there?
There is, and it's really important context. That modest slide came after a much sharper sell-off earlier in the month.
Ah, right. They put out a preliminary profit warning.
Exactly. So that warning had already reset expectations much lower. It suggests investors weren't really surprised by the Q2 weakness itself. The focus now seems to be squarely on management's ability to actually execute a turnaround.
Okay, that makes sense. So let's dig into that fiber solutions segment then. That's clearly the elephant in the room here. Still their biggest segment, right? About 65% of sales.
That's right. Still the largest piece.
And you mentioned its EBITDA margin was just 6.4% this quarter. Management actually called it a turnaround situation. Why is this core business struggling so much?
Yeah, this really is the heart of their current challenge. And management calling it a turnaround situation is pretty blunt. It seems heavy investments made previously just haven't delivered the expected returns. And fundamentally, demand was just lower than they anticipated.
Where was the demand weakness most pronounced?
Particularly in North America. Sales there saw a pretty sharp 23% year-over-year decline.
23%. Wow. Did they give specific reasons for that North American slowdown? Is it Hexatronic specific or broader trends?
They pointed to a mix of things, really. Some customers having trouble getting permits for new fiber builds, delaying projects.
Okay, permits. That's a common one.
Yeah. Also, some customers apparently being overstocked from orders in previous quarters. Mm-hmm. And then some customers facing financial constraints, maybe leverage issues after acquisitions, which is impacting their ability to fund build-out plans.
So a combination of factors hitting their customers there.
Right. And even their conduit business, which is part of Fiber Solutions, they said volumes were okay, but they faced significant price pressure. That tells you something about the competitive intensity.
Yeah. Definitely points to a tough market. And what about Europe for fiber solutions? Similar pressures there.
The outlook for Europe is also expected to remain pretty subdued. They flagged overcapacity and intense competition as the main issues. Germany specifically was highlighted as being the toughest market on pricing right now.
Overcapacity and pricing pressure in Europe too. Interesting. Did they comment on where growth is happening in the broader fiber market?
They did acknowledge that the overall fiber market does have growth areas, particularly things like backbone networks and data center interconnect segments. But, and this is key, they also admitted they aren't as strong in those specific areas as some of their peers who seem to be performing better.
Ah, okay. So their traditional strength is elsewhere.
Yeah, their traditional strength is more in the fiber to the home or FTT last mile part of the network. And that's precisely the area facing more challenges, especially in Europe right now.
That makes sense. It suggests those better performing peers might be more exposed to those backbone and interconnect markets or perhaps enterprise builds.
Could be. It definitely points to a need for Hexatronic to reassess where they focus within fiber solutions or perhaps, like you said, pivot resources.
So given all these headwinds in their biggest segment, the CEO, Ricardo Froberg, he promised a big cost-cutting program in fiber solutions, but he also really emphasized the strategic pivot towards the faster-growing data center and harsh environment segments. Are we seeing real evidence of that pivot?
It certainly looks like a genuine pivot, yes. And the numbers really back it up. Get this. Data center and harsh environment combined now generate well over 50% of the company's total Q2 profits.
Over half the profit, despite being smaller in sales than fiber solutions.
Exactly. Even though fiber solutions is about 65% of sales, these other two segments are delivering more than half the actual profit. That really highlights where the value is being created right now and likely where the future focus needs to be.
Wow, that's a stark difference. And the data center segment in particular, you called it a star performer. Record EBITDA margin of 20.8%. That's huge.
It really is impressive. It definitely exceeded expectations, and they said it was driven by some higher margin projects coming through. And the outlook there is strong too. The cloud part of the data center market is expected to grow at something like a 15% compound annual growth rate, phase ER, from 2025 to 2029.
So they're riding a strong market wave, but are they doing anything specific to boost performance there?
Yes, they're actively diversifying within the data center business. It's not just about selling fiber cables anymore. They're moving more into services like design, installation, but also adding indoor services, things like wireless and security solutions within buildings.
Okay, higher value services.
Right. And they're even expanding beyond just data centers, looking at similar service opportunities in places like hospitals and commercial buildings. They see the services market as quite fragmented, making it ideal for M&A too. So this diversification is key to that strong margin.
That makes a lot of sense, moving up the value chain and into adjacent markets. What about the harsh environment segment? What's the story there?
Harsh environment also had a solid quarter. Achieved 10% organic growth, which is excellent. Now, this is more of a project-based business, so it can be a bit lumpy quarter to quarter, but right now it's seeing strong investment flowing from defense and offshore energy markets.
Defense and offshore energy, okay. Makes sense.
Yeah. Management did guide for Q3 sales to be roughly in line with last year, suggesting some of that lumpiness, but they stress the underlying trend is solid. So another strong area for them.
Okay, so strong performance in those two growth engines. Now let's talk financial health. With the struggles in fiber solutions, how's the balance sheet holding up? Cash flow.
Yeah, that's important. The good news is cash flow did turn positive as they expected it would. They generated about SEK 131 million in the quarter with a pretty healthy 74% cash conversion rate.
74%, that's solid. And debt?
Net debt leverage remains stable at 1.9 times EBITDA. So they seem to be managing the finances well despite the operational headwinds in one part of the business.
Good to hear. And what about capital expenditure, CapEx? Are they still pouring money into fiber solutions capacity, or is that easing off?
CapEx was actually quite modest this quarter, only SEK 30 million, and most of that was just for maintenance. Management was clear that the big capacity investments in fiber solutions are largely done, finished.
Okay, so the spending phase there is mostly over.
Seems so. Future CapEx will be mainly maintenance, plus maybe some specific growth areas like submarine cable. Crucially, they view the data center business as being capital light, which is obviously good for profitability as they pivot towards it.
Capital light growth, that's always attractive. So looking ahead to Q3 then, what's the immediate outlook for these segments?
For Q3, they expect fiber solutions EBITDA margins to be basically in line with Q2. So around that 6.4% mark again. They said the new cost-cutting program won't really have a material impact just yet. It'll take time.
Okay, no quick fix there.
No. But data center is expected to continue its strong growth trajectory. And harsh environment, as I mentioned, is expected to be roughly in line with last year's Q3 sales.
And you mentioned M&A earlier, focusing on those growth areas.
Oh, yes, absolutely. They emphasize having a robust M&A pipeline. and it's focused squarely on data center and harsh environment targets. They actually have an ambition to close one or maybe a few deals before the end of this year. They clearly see acquisitions as a key way to accelerate the pivot and create value.
That M&A focus really does underline the strategic shift. And they've got an investor update coming up soon to provide more detail, right?
Correct. September 11th. Definitely one for investors to watch. They plan to present an updated strategy, give a status update on all three business areas, and crucially, provide more granular details on that Fiber Solutions Performance Improvement Program, including, importantly, new financial targets for each business area.
Okay, so that September update sounds critical for understanding the roadmap.
Yeah, it should give a much clearer picture of how they see the company evolving and what the financial goals are for each part.
So, summing this up, it really feels like Hexatronic is at a major strategic turning point. You've got the traditional core, Fiber Solutions, facing some serious headwinds over capacity in Europe, customer issues, and price pressure in North America. It's tough.
It is tough. But then you have this clear silver lining, almost like a different company emerging within Hexatronic. The data center and harsh environment segments are not just performing well, they're becoming strategically central, driving profitability.
Exactly. It's like two different stories under one roof right now.
And the market reaction, or lack thereof after the earnings, suggest investors kind of already knew about the Fiber Solutions problems because of that earlier warning. So the focus now really shifts. Can management actually pull off this Fiber Solutions turnaround or at least stabilize it? And maybe more importantly, can they keep accelerating the growth and profit contribution from data center and harsh environment? It's about execution now.
Right. It's about changing the narrative, changing the perception.
Turning that perception problem into a potential re-rating opportunity down the line.
And it's precisely this gap, this strategic shift where maybe the market perception hasn't fully caught up yet, that leads us to our next segment. It's time for This Is Not Financial Advice, where we float an outrageous but plausible trade idea based on what we've just discussed. Okay, let's get into it. Given this dramatic split in performance and management being so explicit about the pivot, here's where it gets, well, really interesting for a provocative idea. Let's call it the Hexatronic re-rating play. Now, this isn't your standard long stock A, short stock B kind of thing. This is more fundamental. It's a thesis about a potential re-rating of the entire company.
Okay, I'm listening. A re-rating thesis.
Right. The idea is this. The current valuation, the current stock price, likely reflects the well-known struggles in the Fiber Solutions business. That's what's weighing it down. So the trade idea is a long position in Hexatronic, but it's based on the conviction, the bet, that over the next, say, 12 to 18 months, the market will start to see Hexatronic differently.
How different?
Less like a struggling traditional fiber cable company, and more like a high-growth, relatively asset-light provider focused on data centers and specialized harsh environment connectivity. You're betting on a shift in perception driven by the changing business mix.
Okay, so what needs to happen for that bet to pay off?
Well, it hinges on two key things, really. One, the Fiber Solutions Performance Improvement Program needs to be effective. Maybe not wildly successful, but effective enough to stop the bleeding, stabilize the margins there, to put a floor under it.
Right, contain the damage.
Exactly. And then two, you need the continued stellar performance and, crucially, accelerated growth from data center and a harsh environment. That acceleration could come organically, but also through the M&A they're talking about. Eventually, these segments need to clearly outgrow Fiber Solutions, not just in profit contribution, which they're already doing, but also in terms of the market's perception of the quality of those earnings.
So you're betting the market starts valuing those higher growth, higher margin segments more, and the Fiber Solutions drag becomes less significant in the overall picture.
Precisely. And here's the outrageous part. It's a bet on that perception shifting dramatically, moving past the current headline misses, past the Fiber Solutions problems, and recognizing the value locked up in these faster-growing, higher-margin businesses that are becoming the core profit drivers. If that happens, you could potentially see a significant multiple expansion for the stock as the business mix visibly transforms. Essentially, the provocative idea is, you're buying the Fiber Solutions problem almost for free today to get exposure to what could be seen as a high-growth data center and specialized connectivity play tomorrow.
Definitely provocative. Betting on a perception change as much as operational execution.
Exactly. It requires patience and belief in the strategic pivot.
Okay, so wrapping this up, what does this all really mean for you, the listener, taking this all in? Hexatronic's Q2 was, well, definitely a mixed bag. You had a material miss driven by that large fiber solutions segment.
Yeah, you can't ignore that. But it was strongly offset, at least in profitability terms, by the performance from data center and harsh environment.
Right. And the company is clearly signaling and seemingly acting on a major strategic pivot. They're aiming to cut costs and stabilize fiber solutions while really pushing investment and M&A in those higher growth areas.
It's a bold strategy shift. And that upcoming September investor update looks absolutely crucial for getting more detail on how this transformation is actually going to play out and what the new targets look like.
Absolutely. Now remember, this deep dive is all about giving you insights based on the latest information straight from the company. Any investment decisions you make should always be based on your own thorough research and ideally financial advice tailored to you.
Definitely. We've laid out the challenges here, particularly in fiber solutions, but we've also highlighted the opportunities, especially in data center and harsh environment, and this potential re-rating story. That September update is key. So what stands out most to you from this deep dive? We really encourage you to keep thinking about the implications of this major strategic shift for Hexatronic's future.